So good morning, everyone. Good morning, everyone. Am I audible? Okay, this will be a short presentation in which we will try to explain just what the introduction was all about. And in a nutshell, I would like to keep it lively and interactive. You can ask questions if you have any. The basic theme of this presentation is like what we did in COVID, Aapda mein Afsar, or opportunity in a problem. So this is what the theme is going to be. So starting on, this is the plus. Yeah, okay. So the key point to start with this is India today is not a distressed market. On the contrary, it is one of the fastest growing and most resilient credit markets in the world. The economy is growing over 7%, inflation remains under control, and the fiscal position is improving. The banking system is showing historically low levels of stressed assets. Gross NPAs are at 2.1%, and net NPAs are at just 0.5%. At the same time, capital adequacy remains strong, with CRAR above 17%. When people talk about NPA, they often assume about a financial system in crisis. But this is not a crisis story. And it is a story of a matured, well-capitalized, and expanding credit system. And in such systems, strategic NPA management becomes a tool of financial efficiency, not a crisis response. The second factor to highlight is the rapid scaling of lending driven by digitalization. India has built one of the world's most powerful digital financial infrastructures, Aadhaar, UPI, and eKYC. As a result, millions of borrowers have gained access to formal credit for the first time. Unsecured retail lending is growing especially fast, including credit cards, BNPL, and microfinance. At the same time, the gig economy is expanding, a segment characterized by unstable income streams but a strong demand for flexible credit products. It is important to understand that when a credit system scales digitally, the risk scales structurally as well. Even if the NPA ratios remain low, the absolute volume of potential stress increases in line with the growth of the credit base. This is a natural and expected dynamic of a rapidly growing economy. Today's India's gross NPA, the GNPA, stands at 2.1%, a historic low. However, in absolute terms, this represents more than 4.3 trillion INR in stressed assets. Yes, the slippage ratio, the new NPA formation, has been declining for the 5th consecutive year. Yes, underwriting discipline is improving, but credit growth continues at double-digit rates. In any large and fast-growing economy's credit system, NPLs are not an exception. They are a recurring part of the cycle. The difference between mature and immature financial systems is not the absence of bad loans, but the efficiency of how they manage and resolve them. And this is exactly where strategic portfolio transactions become a powerful tool to enhance balance sheet quality. So RBI data for financial year 25 indicates a clear structural shift. 12.4% of previous year's stressed assets were resolved through market sales, compared to 5.8% in the prior year, representing more than a twofold increase. Private sector banks nearly sold 36% of their stressed assets, while foreign banks sold over 55%. This is an important signal. The most capital efficient and market-driven institutions are increasingly using secondary market as a balance sheet management tool. Portfolio sales are no longer a last resort. They are becoming a strategic lever. I can confidently say that NPL portfolio sales are no longer an exception. They are a clear market trend. We see it very clearly, and the reason this trend is accelerating is driven by several structural factors. First, the continued expansion of credit is increasing the overall size of the loan books. Second, growing pressure on return on equity is forcing lenders to use their balance sheets more efficiently. Third, the market is experiencing strong liquidity along with rising investor appetite for alternative and distressed assets. Fourth, the availability of digital borrower data enables much more accurate portfolio segmentation, pricing, and underwriting for NPL pools. And finally, legal recovery routes still remain low, often taking 3 to 4 years on average. In this environment, portfolio sales are shifting from being a reactive measure to becoming a strategic tool. It is no longer simply about recognizing losses. It is about accelerating capital rotation and improving balance sheet efficiency. When credit markets reach a certain level of depth, a fully functioning secondary risk market begins to emerge. Risk becomes transferable, it becomes priceable, and it becomes an asset class traded through financial transactions. India is now entering exactly this phase. Data is increasingly transparent, the infrastructure is mature, the capital is available. This means that NPL management will be more institutional, structured, and scalable. A matured credit system cannot exist without an active secondary market. In this ecosystem, institutional capital plays a critical role. Investment funds specializing in portfolio acquisitions provide immediate liquidity to the banks and fintech lenders. They take over the risk, perform deep analytical segmentation, structure transactions, and manage recoveries through professional platforms and processes. For financial institutions, this delivers clear benefits: improved balance sheet quality, capital release, faster credit growth, reduced volatility in key performance metrics. Strategic portfolio sales transform NPLs from a constraint into a capital management tool. And while NPL ratios have been declining in recent years, we clearly see that India's NPL market is not disappearing. It is becoming institutionalized, and that is a key sign of a maturing financial market. So I'm excited to introduce to you our parent company, R2P Invest Sikov AS. It is a Czech-based investment fund established in 2018, regulated by the Czech National Bank, which means we operate fully under a recognized European regulatory framework. The fund is designed for qualified investors, and today we have already more than 1,500 investors, most of them coming from Central Europe. Now, what is important? The fund strategy is very clear and very practical. Through its subsidiaries and local SPVs, the fund identifies and invests in proven portfolios of distressed debt, mainly across Europe, America, and Central Asia. These portfolios are then professionally managed by MBA Consult, a reputable international collection company operating since 1996. So the model is simple. The Czech fund invests into the portfolio through an SPV. The portfolio is professionally serviced and collected, and once collections are realized, the capital together with the interest is returned back to the fund. And because of this structure, the entire cycle can be repeated, which makes the strategy scalable and sustainable. So that's the geography. The geography includes Asia, within Asia, Indonesia, Philippines, India, Kazakhstan, Uzbekistan. On the Latin America, we have Mexico, Brazil. The US, the largest NPL market. Europe, we have the Czech, Slovakia, and Serbia. So about R2P capital, and this is the most important step about R2P capital and our expansion in India. For the last 10 years, the fund's presence in India was represented through MBA Consulting, which provided local expertise in debt management and collections. But today, we are proud to say that our presence in India is even stronger. The fund is now also represented through R2B Capital Private Limited, a licensed non-banking company or NBFC, regulated by the Reserve Bank of India. This is a very important milestone for us because it means we can operate in India with a fully compliant structure and directly support lending and investment activity on the ground. Through R2B Capital, we will partner with banks, NBFCs, and fintech companies to analyze and settle non-performing receivables, invest in NPL portfolios across India, and also conduct lending services. What makes our approach unique is that we operate together with MBA Consulting through a proven ecosystem model. So we don't just buy assets, we can deliver end-to-end servicing, from acquisition to full recovery, strategy, and execution. In addition, the R2B Capital's lending strategy focuses on clearly defined retail credit products tailored to an urban and semi-urban individuals, especially the women, and also small businesses. So in summary, R2P Invest and R2P Capital combine Czech investment expertise with global reach across Asia, Latin America, and the US and Europe to deliver professional, compliant, and scalable investment solutions. And maybe the most important part is what actually delivers to our partners. So with our solutions, strategic portfolio sales allow banks and originators to transform NPL from a balance sheet problem into a real capital management solution. In practice, a few key things. First, the balance sheet optimization. Instead of holding distressed assets, the originator can clean up the balance sheet and move key ratios. Second, the portfolio segmentation and analytic underwriting. We don't treat NPLs as one big block. We structure deals based on real recovery potential. Third, and very importantly, immediate liquidity. The originator converts the non-performing assets into cash. At the same time, it enables risk transfer and restructuring. So the credit risk is moved away from the balance sheet and managed responsibly. And finally, the strategic benefit, it enables capital recycling into new lending. So the originator can invest capital back into growth and the new business. So overall, this is what we deliver: liquidity, risk relief, balance sheet flexibility, while creating a clear, structured investment opportunity for our fund and investors. So thank you so much for paying so much of attention, ladies and gentlemen. That's all for today. Thank you so much once again.